Good morning from India and welcome back for part 2 of this webinar series on illegal global trade by Fintelekt Advisory Services and global financial integrity. I'm ARPITA BEDEKAR from Fintelekt and I have with me LAKSHMI Kumar, Policy Director at Global Financial Integrity, a recognized expert having briefed governments and government agencies on the issues and policy interventions around illicit global trade. LAKSHMI is currently co-teaching an executive online certificate course on trade-based money laundering at the Shah School of Policy and Government at George Mason University. Hi, LAKSHMI. How are you doing today?
No, good morning as well, Arpita. So thank you so much for having me back again to do part 2 of the webinar.
Right. I trust that most of the participants who have joined us today would have either attended part 1, which was held last Wednesday, or have seen a recording of it on our YouTube channel. In part 1, just to recap, LAKSHMI covered the factors involved in illegal gold trade and the risks for banks and financial institutions. And today, in the second and concluding part, we will discuss the policy options for the government and private sector to address the risks of TBML in the illicit gold trade and the effectiveness of ongoing policy measures. I must mention that we have had very positive response for part 1 of this webinar series, and thank you very much for all your comments and feedback. As we move into part 2, a very few quick instructions. Today's webinar will also be available on Fintelekt's YouTube channel. The chat feature is disabled, but you can post your questions in the QA box at the bottom of your screen, and we'll try and take up as many questions as we can in the last 10 to 15 minutes. And for those of you who would like to purchase participation certificates for this webinar series, we will be sending out payment details in our follow-up email tomorrow. So without further ado, handing over to you, LAKSHMI.
Thank you so much, Arpita. I'm a big fan of facts and figures, and I thought, we started last week's presentation with some facts and figures on the Indian gold trade. And I thought, why stop with that? So for this week, a couple of other things that I wanted to share is because I think the question we left at last time is, the risk of the Indian banking, the risk that the Indian banking sector bears vis-a-vis sort of the gold sector or the sort of, rather the jewelry market in general. And sort of going back to the height of the 2080 money laundering scam, sort of estimates around then show that the Indian banking sector exposure to gold was around sort of, $40.83 billion US dollars. And this was something that, the Indian Bullion and Jewelers Association arrived at when they had sent their letter to the Reserve Bank of India, sort of highlighting some of the risks they saw with the RBI policy on gold. Another sort of big number to sort of understand the importance of the Indian market, but also therefore the risks, which is that the Indian jewelry sector contributes to 29% of global consumption. The world's largest refinery, which is Alkambi in Switzerland, is actually wholly owned by an Indian company, Rajesh Exports Limited. Alkambi was acquired in 2015 for an all-cash purchase of $400 million US dollars. This means that because of that, more than ever, India is purchasing gold from Switzerland, about 30%. The capacity of Alkambi is estimated to be around 1,600 tons refining capacity. Now, sort of with all of this, to sort of further understand the nature of the Indian gold market and therefore what risks this presents is you have both the formal banking sector as well as the informal sector. And I'm sure there are almost a lot of you that are on the webinar today must know that India culturally has a tradition of using sort of gold to acquire loans both privately through the formal banking sector, but also through sort of the informal lending sector. Now, a look at sort of 9 scheduled commercial banks, because these reports were not available for all the scheduled commercial banks of India, showed that they hold $6 billion US dollars as personal loans that were given out with gold as collateral. So that's again another huge number just based on sort of financial years. Similarly, the government of India, which conducts this All India Investment and Debt Survey, 2012 found that of all the states that had sort of over 10% of their debt in gold loans, Tamil Nadu and Puducherry was sort of leading, where in Puducherry was close to as high as 50% of debts were in sort of gold loans, and in Tamil Nadu it was high as almost over 41%. You know, and you can see with the other states, Manipur, Kerala, you see the map of India. The darker the blue color, that represents sort of the greater consumption of gold within the country. And you can see sort of, especially the South India, as you move further south, the consumption tends to be sort of larger vis-a-vis when you compare it to sort of other parts of the country. Now, with sort of, you know, that, I mean, last time we spoke a lot about sort of the fact that, you know, in the US and especially in Europe, the focus is very much on supply chain integrity and knowing where your gold comes. Essentially, whether your gold is conflict gold. The Human Rights Watch, which is you know, fairly well recognized and well established civil society organization in the US, human rights supply chain mechanics, and especially sitting on this side of the sort of hemisphere, because supply chain due diligence and the risks of conflict gold are so prominent, that, you know, the Indian jewelers, Tanishq, Kalyan, and Tribhuvandas Biyunji Zaveri, all rank very low. Jewelers based in the US and elsewhere received a lot of flack for not having clear due diligence and supply chain processes, and which is why you see a tendency with sort of, you know, European and sort of more the Western jewelry companies that have sort of operate in similar volumes, moving slightly further with Tiffany rank. India, as I mentioned, you know, Rajesh Exports wholly owns Valkambi, the largest refinery in the world. Now, what is unique and interesting about Rajesh Exports, when we look at the whole world of illicit gold, as well as sort of the supply chain mechanics of gold, which is that the Rajesh Exports caters to all services across the entire supply chain, from refining to retailing. So a lot of them, like, you know, like Tiffany or Bulgari or even Tanishq, you know, they handle the retail portion. Refining is done by someone else, the mining is done by someone else. Rajesh Exports is unique in the sense that it is able, because of its market foothold, is able to really span a much larger segment of the supply chain. And therefore, you know, for those interested in understanding India's supply chain mechanics, as well as money laundering risks, the operations of Rajesh Exports particularly provide sort of a great window into that. The company's stock has grown by over 561% between 2016 and 2018, and a lot of that was due to the acquisition of Valkambi. On the downside, sort of one of sort of maybe a concern which, you know, has been highlighted, and the case hasn't really gone very far, was that Rajesh Exports was one of the 13 companies that sort of trading firms that sort of benefited from the 80-20 money laundering scheme, which cost India millions and millions of dollars in losses in revenue, because it was essentially turned out to be a money laundering scheme, which hasn't yet seen the light of day in terms of sort of prosecutions or convictions. But it's as the CAG report indicated, it was replete with egregious trading practices. Also in 2002, Rajesh Export, because of circular trading, was essentially banned for a securities appellate tribunal from accessing the capital market, and also dealing in securities for 3 years. None of those things hold in the present time. Now, the question is, you know, how do we look at the areas for policy intervention? And this is really an artificial separation of how we look at the areas for policy intervention with gold. You know, and I've really sort of thought about this in 4 components, which is, one is the question of supply chain integrity. The other is customs, and there's trade finance, and there's commodity market trading, by which I mean really sort of, you know, commodity traders as well as trading on the exchange platform, which you see. Now, under each of it, you see different components of money laundering or corruption or illicit finance risks that come in. As you can see here, you know, essentially broadly, all 4 of them broadly cover issues of anti-money laundering, trade-based money laundering, anti-corruption, especially in the case of the US, sanctions, environmental protections, human rights, market fraud. And what is unique, especially about India, is that it's definitely concerned more about sort of, you know, the ability to collect duties, customs duties, as well as the macroeconomic implications. And a lot of the policies in India really are sandwiched between Section 2 and Section 3, which is the trade finance and the issue of customs, because the Indian government sees it as largely as a source of revenue. But at the same time, because of the debt risks to the Indian banking sector since 2015, India's FIU has been very, very proactive about sort of putting forward TBML indicators on the sector. The question of how efficacious some of it has been is another question, but really India's policy interventions are sandwiched between 2 and 3. So that leaves the question of sort of, where India is with 1 and 4, which is, that really is, these are policy areas where there's a lot more room for India to take proactive measures or to take measures that are more in line with sort of current international standards. Interestingly, what you see sort of on the US side of things is that a lot of the measures are essentially very much concentrated on, segment 1 of the circle that you see, which is on supply chain integrity, and through which sanctions, environmental protections, human rights, anti-corruption, and AML are sandwiched. On the customs side to a degree, but most of it is focused on TBML and not really on the collection of sort of, duties. That isn't the thrust of the customs work. Customs work is really the thrust of trying to prevent organized crime, transnational organized crime like drug trafficking groups from accessing it. So even when you split these areas of policy interventions into segments, you can see the distinct approaches. But what is uniform for both is sort of the fact that commodity market trading is still not yet fully tapped into just because of the complexities of it. Now, sort of to just jump straight into the weeds of this. As I mentioned sort of in the last webinar, actually, before we sort of jump into Dubai, ARPITA, if we could sort of do the first poll, that would be fantastic.
Sure, Lakshmi.
So, the interesting thing about making policy or regulatory policy is what motivates in each jurisdiction. And we find that, when we look at Asia, Europe, North America, Africa, it's very different policy considerations that make sort of governments or private sectors actually implement policies to sort of mitigate illicit gold trade. So I'm happy to sort of discuss what I've seen elsewhere, but that's why I wanted to sort of see from some of our attendees, what is it that you think, why does the illicit gold trade issue matter in the context that you work in? And I can also tell you from having done this poll a couple of times already, there is one answer that I find particularly critical to my work that almost has very rarely come up in the actually selected answers. And the hope is that and I often see it as the other side of money laundering, but let's see. Okay.
Here are the results.
And we have the results. Okay, money laundering, 91% money laundering, financial risk, funding corruption. That's close. So funding corruption, 55%, organized crime, drug trafficking, 40. So we really see the top 3 as being sort of money laundering, financial risk, drug trafficking, funding corruption. So I can tell you from having done this on the US side, environmental damage was a much bigger component of the answer. National security, as you can expect, was large. Human trafficking was also quite big. And as I mentioned, development was, as I expected, was really low on both sides. And the reason I think I focus a lot of my work also focuses on, apart from everything else, focuses on development, is because illicit, the gold sector is a form of financial inclusion, is a form of sort of inclusion through trade for lots of sort of communities, especially in the developing world. So therefore, improperly targeting the money laundering risk means improperly finding solutions to include people within the financial system. And because these are two sides of the coin, especially in India, I think, because financial inclusion is such a big component of the work we can do, we can appreciate that. But this is really useful for my sort of collection of responses. Now, as I mentioned sort of last week, we sort of really touched upon the role of Dubai, between the FinCEN leaks. And the fact that, you know, the Dubai Multi-Commodity Center is really the epicenter sort of the gold trade for a lot of sort of, you know, Asia, Africa, and even for that matter, sort of gold that's coming in from Europe and North America and Latin America. It really is sort of the hub of the gold trade in many ways. Yet, like Calotte refineries and so many of others have received criticism. So taking a look at sort of what the laws are and how they impact is especially useful, I think, from the Indian context, because it allows you to see where the compliance levels are and how sort of Indian financial institutions, companies in the sector should look at their risk when facing the UAE. Now, for instance, of sort of the only 3 of the 11 refineries in Dubai are compliant with its sort of own standards for its refineries. At the same time, the fact that only 3 of them are compliant does not prohibit Dubai's refineries from trading between themselves. So essentially, you know, let's say I'm a refinery that is not compliant and there's another refinery that is compliant. I can do intra-trading between 2 refineries, and that doesn't get picked up within trade transactions. The refinery that has the certification, you know, you're able to move sort of gold that is non-compliant into a compliant market. So there is the ability to sort of move that, which is quite concerning. The other thing is that, you know, this standard, the DMCC, it's both the regulator and promoter of trade. So essentially, both supervision as well as trade promotion is contained within the same body, and that's actually a conflict of risk. You know, you can't have the trade promotion board and, for instance, sort of, you know, SEBI or RBI within the same body. That's a conflict of risk and conflict of interest, and that's what you see a lot in Dubai. Now, a lot of Dubai's gold trade also goes to the souks, where you can just come in, hand gold and buy it. And a lot of these requirements that you see here on the left-hand side don't apply to the souks at all. Additionally, when you go, a lot of Dubai, the gold that comes into Dubai is just flown in. So I can carry gold in my handbag, walk into the Dubai airport, fill out the customs declaration form, just saying, oh, this is how much the value of gold. Go to a souk in Dubai, trade my gold, no questions asked. So that's another sort of huge risk, because Dubai has a huge history of people carrying, as we recently saw in the Kerala gold smuggling case, over 250 kilos of gold were just flown from the UAE into Kerala. And so the same thing can happen vice versa from other countries into UAE with no questions asked, no questions on the supply chain. Now, the Dubai anti-money laundering provisions create very broad general obligations. The truth is that the only more exacting guidance, which is what is called the supplemental guidance on dealers, since 2019 has been in a draft consultation phase. This is the most robust guidance in Dubai and sort of for the UAE, but it covers physical, virtual, wholesale, retail. It covers origins, but it's not a law that's in effect. So the law that's in effect, which is the DMCC guidance, essentially just takes very broad anti-money laundering language and duplicates it, which essentially means it creates no obligations. Now, if you wanted sort of further evidence of why this remains an issue in Dubai, all you have to look at is the suspicious transaction reporting that Dubai has filed. The DMCC and the DIFC, which together recorded $35 billion in trade flows, only submitted 109 suspicious transaction reports for the whole of 2018. And this is with $35 billion in trade flow going through. And it covers the whole of the financial system and the whole of the gold sector. The DIFC has more banking institutions than Asia, Africa, and the Middle East combined within the DIFC. So it is deeply concerning that you aren't seeing more coming out. Now, in light of all of this, what do you, if you're sitting in Asia, how do you look at sort of the policy movements in the UAE? A couple of months ago in August, the UAE passed a new law requiring the creation of a beneficial ownership register with a deadline for filing all this information by the 27th of October. Now, the problem is that of all the companies located in the UAE, only 717 are located on the mainland. Over 4,000 are located in Dubai's free trade zones or free zones. Now, what even a very superficial examination of the law will show you is that it excludes the companies registered in the DIFC and the Dubai Multi-Commodity Center from submitting beneficial ownership information to this register. That's a weakness, and that's sort of a concern about, again, why the exclusion of all companies to the beneficial ownership register, why it only captures companies located in certain areas, especially parts of the country where there are a minority of the companies located. This is a sort of a slide that I did where I tried to map out where all the free zones in Dubai are located, because it is an incredibly hard task to do. Now, this becomes relevant, the slide you're seeing as we talk about this further, which is the gold supply chain. The gold supply chain is essentially two parts. There's the upstream, there's the downstream. The financing occurs through the supply chain, and so are the AML risks. But when we start looking at Swiss law, which is again another should be of concern to India, we can see sort of, as I like to put it, the legal acrobatics at play between how the Swiss law defines the upstream supply chain risks and the downstream supply chain risks. The art of legal gymnastics. Swiss law, while on the surface appearing to be robust, is well crafted and well designed to essentially create carve-outs to protect the real sort of the heart of the Swiss gold trade. The heart of the Swiss gold trade is untouched. So, for example, Switzerland has the Precious Metals Control Act now, which addresses the import of precious metals into Switzerland. It talks about lawful acquisition. Lawful acquisition just means smuggling. Again, because a lot of international efforts are focused on the supply chain origins, this very conveniently creates no obligation to do that. Similarly, the Anti-Money Laundering Act of Switzerland covers gold only that is subject to financial intermediation. Essentially, this once again excludes most of the Swiss gold business, because it does not cover the non-monetary trade of gold, which is a lot of gold that comes into Switzerland, as you know, because it's one of the world's largest, it is the largest refiner of gold. It excludes the commodity trading of gold, because most private traders that trade gold trade for themselves. They're not trading for a third party. Additionally, the Anti-Money Laundering Act restricts the meaning of essentially the meaning of gold to only cover monetary used gold, because it requires the gold to have a standardization of 995 parts per thousand, which is essentially bullion gold. Everything else is not a part of is not subject to AML obligations, yet the bulk of Swiss trade covers gold that doesn't meet these criteria. So then the next question is that, a lot of sort of the refineries that we see in Switzerland, as well as companies in Switzerland, really, claim to have certifications for the LBMA, Responsible Jewelry Council. Even in India, the NSE, the National Stock Exchange, and the Bombay Stock Exchange, NSE, when it trades in sort of bullion gold, requires the gold to have sort of LBMA certifications. And there's the question of, hey, what does this really mean? And are these standards as adequate as we think they are? Now, as I said in the earlier part, the hard law obligations, which is the Prevention of Money Laundering, as well as the Precious Metals Control Act, really governs the downstream obligations, which means once the gold has reached the refineries, that's when the obligations start. It's like, oh, who are you selling it to? And the truth is that a lot of the gold that's coming into Switzerland, the risks to that gold come from the upstream obligations. Now, when you look at the upstream obligations that Switzerland has to comply with, those are actually soft law. These are all voluntary standards. It is not defined in law that, at least on the upstream side, when Switzerland sources its gold, it has to sort of adhere to hard law norms. And so it's a very delicate balancing act that Switzerland has done in both sort of creating norms, but also creating norms that are convenient to the country and to its gold sector. For example, the LBMA is the only accepted accreditation for the bullion market. However, it is a purely voluntary standard. But at the same time, as is with a lot of these cases, instead of, it's, you say the fox guarding the hen house. In this case, it's foxes guarding other foxes, because some of the refineries that have been implicated in some sort of, the illicit gold trade, or having issues with sort of illicit gold, also sort of are the most powerful and really move the LBMA standard. Additionally, the LBMA standard is only requires you to check one level supplier. It doesn't require you to check through the whole supply chain. So if the person right below me, essentially, so if Switzerland is getting it from a recognized refinery in Dubai, it can get the LBMA check, even if sort of the UAE is then, as I said, acquiring its gold from Venezuela, or if it's acquiring its gold through a sanctions evasion scheme in Iran. Additionally, an OECD audit of LBMA found that the auditors who are doing the audits were actually unqualified. Some of them did not have the qualifications necessary to do the audits for the gold trade. And that should be really concerning. The other big standard a lot of people talk about is the Responsible Jewelry Council. Now, this is a sort of a very popular standard, especially that the jewelry trade uses. Unlike the LBMA, this is essentially really criticized by everyone. Part of the reason, which should be really concerning, is that you can join the RJC and then wait 2 years after joining to actually do anything concrete to acquire the certification, which means for 2 years, you can really just benefit from the reputation of saying, hey, I've got the RAJCC stamp, without adequately doing anything proactive. And that is a huge sort of red flag, or something that detracts from the efficacy of the standard. Additionally, the RJC has 2 standards within it, one which is the chain of custody, and the other one which is the code of practice. The chain of custody essentially tracks supply chain. Of all the RJC members, only 6% have adopted it, which means well over 90% is non-compliant with this. So the RJC sticker by itself doesn't mean anything. The next thing is that the code of practice, which is the lower standard, of which also 33% of its members are non-compliant. Now, what is unique about the RJC is that if I look at my supply chain in terms of where I'm getting my gold, it's not that I have to certify the supply chain one level below. I can certify any part of the supply chain. And as I showed you sort of in the in this sort of graphic that I designed, if you are an RJC, you can certify whichever is the lowest risk, and you can get the RJC stamp. So when you look at sort of the supply chain risk, there are risks from here all the way till it reaches the. So if I were a jeweler, I would look at my supply chain and say, you know what, I'm just going to see which is the lowest risk. It may not be my refiner. It may be just sort of the person sort of the trader, the intermediate trader I'm getting it from. And if I do that, I've got the RJC stamp. So part of this is that even sort of what we consider as incredibly international accepted standards are replete with huge problems and risks that are now being sort of considered and evaluated. ARPITA, could we do the next poll, please?
Sure, Lakshmi.
So, as I mentioned, we're at the height of the 2018 money laundering scheme, which we will discuss, it was felt that, as I mentioned, over 3 lakh crores of the banking sector was dependent, which is well billions of US dollars of the banking sector was tied to the gold sector. So in the wake of that, we've seen that a lot of, even in India, the banking sector now views the gold sector as high risk and is starting to sort of move away from providing loan facilities. So I'm interested, amongst the participant attendees here, what is that relationship that some of you can sort of, maybe talk to? So, and again, as I mentioned the last time, this is unique. This is incredibly unique to what you see when I've done similar polls. And the last time I did it, it was with over 800 participants, and then with 500 participants when I did this. And you do not see these numbers of 80% and above, which again tells you, one, how dependent it is, but also as the Indian government and sort of the different sort of actors within the supply chain formulate policy, you at least know how to concentrate it. And then it really talks about opportunities for a better working relationship between sort of the Indian customs side and the Indian banking sector, which I think are, if you look at India's sort of FATF reports as well as India's national risk assessment, that is still an untapped potential. So I think this has been sort of, this is an incredibly insightful poll for me. Now, having said that, when we start talking about where India's policy, India's policies today are a reflection of India's complicated regulatory policy since independence. And what it is essentially is, it is a history of sort of policy that is flip-flopped. You will have a couple of decades where India sort of takes on a really restrictive policy. Then it really opens up. And then because it has macroeconomic implications, India sort of, tries to constrain the imports of gold. But what has sort of been consistent is that this flip-flopping has meant that every time the government has tried to sort of restrict it in an out of control manner, smuggling in India's ballooned, and therefore these policies have never really been effective. So essentially, right after independence, India's attitude was that, we have to change the Indian sentiment towards gold. We have to reduce national demand, regulate smuggling, and change Indian attitudes towards gold, saying they should not want gold. I think well over 60 years after independence, I think it's very safe to say that is not a workable solution given the subcontinent's love for the yellow metal. After sort of the failure of that in the 1960s to the 1990s, you rarely saw the Gold Control Act and rules that was passed. This again sort of, restricted how Indians could privately hold gold, which is essentially only 2 to 4 kilos between individuals and families. It restricted the quality of gold that Indians could manufacture, Indian jewels, which is essentially only 14 carats. What you saw in both these instances was, smuggling went out of control and ballooned. So the next thing which, India then did is the current regulatory regime is the Prevention of Money Laundering Act. And now the Money Laundering Act in India does not have what you'd call any rules or standards on the gold trade. The schedule of money laundering offenses only covers the Indian Customs Act, which is for customs duty. What it does not do is cover essentially mineral trafficking. It does not cover the Foreign Exchange Management Act. And now you might ask a question about why is this critical? Why should it cover the Foreign Exchange Management Act? India's FEMA Act is the act that is used to regulate trade-based money laundering in the majority of cases. But as I said, the Foreign Exchange Management Act essentially is to use to sort of deal with sort of the external trade and the maintenance of sort of foreign exchange. But in India, the PMLA and the FEMA Act together is used to control sort of money laundering. Especially a lot of TBML schemes are facilitated through and are targeted through, and enforcement is done through the FEMA Act. Now, the difficulty is that in 2017, the government decided that it was going to make it mandatory for in the Indian jewelry sector to keep records of customers' personal identification. But as with India's history of sort of, flip-flopping on regulation, by October 2017, that law was rescinded. And even though customs evasion is a part of it, there's actually the issue of the low number of cases that are also charged under money laundering. On the FEMA side, currently, even though the majority of India's TBML stuff, TBML violations go through both FEMA and PMLA, the Foreign Exchange Management Act only allows for civil punishment and no criminal punishment. Now, in 2019, there was a proposal which said we should, in order for this to be more effective and punitive and to lower the TBML risks within sort of the banking sector, we should make it criminally punishable. However, the Reserve Bank of India felt this would sort of be detrimental to India's FDI, and so it was scrapped. Similarly, the Bureau of Indian Standards, which is now, at least at the commodities exchange level, India has always used, the NSE has always used the LBMA certified gold bars. So the Bureau of Indian Standards, in order to sort of target at least the domestic market share that is not, which, LBMA is really sort of bars that are acquired from outside India, but to sort of, capture the other 50 to 55% of the domestic market, wanted to sort of set standards which allow Indian gold bars to also be traded. Now, much like the LBMA standard, this is voluntary. This standard is again focused on the purity of gold and is not really focused on sort of the illicit financial flow component of it, which is what a lot of the OECD standards and supply chain due diligence standards outside India are moving towards. Finally, India's Customs Act, because, post the Nirav Modi scam, which was, the Punjab National Bank trade-based money laundering scam in 2015, the Indian government realized on the customs side that the technology that was available just was not sufficient to address money laundering, TBML, because most Indian customs at that point was still being manually audited. So there was no way to sort of match import-export transactions. And so in the 2017 financial bill, beneficial ownership was added to the Customs Act. And if you look at sort of what's happened in the recent past, beneficial ownership and the collection of beneficial ownership information, at least on the banking side and the financial side of things, financial side of the market has been around since as late as 2011, 2012. And even then, the issue of anonymous shell companies, Benami transactions going through them is such a systemic issue that the Ministry of Corporate Affairs had to strike off 200,000 companies. Now, it is unclear how beneficial ownership on the customs side is really being enforced and what kind of information is being collected. I think for this to actualize, there needs to be sort of better clarity on how the system is organized, whether it interplays with the Ministry of Corporate Affairs registry on beneficial ownership, because otherwise you're really sort of losing. If there's no interconnectivity of data, you're only looking at one side of the equation, and government agencies aren't able to look at both sides of the problem. Now, in order to sort of really sort of keep this in mind, I wanted to sort of just talk about two cases, because last week I promised that I would talk about go in depth sort of with two cases. The first one is the Sri Ganesh jewelry scam, which essentially the investigations are now looking at a total fraud of US $1.63 billion, which is about 12,000 crores. In this scam, as in so many other scams, Sri Ganesh jewelry was based out of sort of Kolkata. The company received loans to around 2,672 crores from a consortium of banks led by SBI. What the company really did was essentially they would import gold duty free because they were based out of a special economic zone, and then they exported gold. But of the gold that they exported, 1,700 kilos of gold was diverted. Essentially, they would export gold, but then the sale proceeds for the export gold, they would never actually realize, take back, and then pay off their bank creditors. What they were able to do by doing this scheme of sort of diverting their gold exports and without receiving payment is they would increase their balance sheets, showing this is the kind of trading volumes they would do, which means they would be able to get more loans from banks. And it was a vicious cycle, and then they would take these loans and divert it. Using sort of the money they acquired, what they did was they acquired over 48 properties that we know of that have been seized so far by the government, based in Bombay, Mumbai, Pune, Hyderabad, factories as well. Now, what is still being pursued is that some of this money was moved out of India or back into India through Hawala channels. And this is very similar to the Kerala gold smuggling case, where you see that on one hand, you are sort of, duping banks that are providing your trade finance facilities, but then you're sort of moving the money back into India and elsewhere and settling it through sort of essentially Hawala mechanisms. Now, this scheme really, this movement that you see into multiple jurisdictions, it went from sort of Kolkata to the UAE, from India to Hong Kong, India to Singapore. And in all these cases, companies that were set up were essentially wholly owned by the Indian entity. And this case has been ongoing since 2017, 2018. Just a couple of months ago in 2020, there was another raid that was conducted on associate companies because they were still trying to continue the scam. And this, again emphasizes the high risk that is posed to sort of, the banking sector through this. The show cause notice that was issued by FEMA because of this scam, because a lot of it was a violation of Foreign Exchange Management Act, is the highest show cost ever issued through FEMA, which is nearly touching $1 billion US. And that's the size of the scam. Now, as I mentioned, the 2080 TBML money laundering scam is particularly noteworthy because this came right before the discovery of sort of, the Punjab National scam and the Nirav Modi scam. Because a lot of Nirav Modi was implicated in that, but was also a part of this scam. Essentially, this was at a time when India felt that India's foreign exchange was, a lot of it was being used to sort of purchase gold, and it wanted to restrict gold imports, but also protect the Indian jewelry sector. So RBI issued a circular which essentially said that you can, if you're importing gold, you can only import gold if 80% is used domestically and 20% then can go for export. You in order to sort of, do the import-export norm, you have to split it between 20% to 80%. So 80% has to be sort of a domestic consumption, and then 20% can go out. What happened is that while this was initially only restricted to sort of, notified agencies, as they were called at that time, which is essentially companies and banks that had experience in sort of the export-import of gold and supplying it to the domestic market, the rules were loosened to extend it to others, what they called star trading houses and preferential export houses. Some of these companies were just, rice exporters to stockbroking firms to manufacturing conglomerates. And what India really saw is that through this scheme, it artificially inflated prices, it caused the hoarding of gold in India, and it caused huge losses of revenues that were in the millions and millions of US dollars that we discussed the last time. Much like in the previous scam, in this scam as well, companies continue to exploit the banking sector by creating these fictitious circular trades, inflating their balance sheets, and then receiving increased loans from banks. Now, essentially, the way the scheme sort of worked was that gold was imported at this point from all over Asia, including the UAE and Hong Kong. Now, what would happen is that, once the gold was imported, because of the 2080 rule, on the Indian side, these companies would, because India is sort of, this was meant to sort of, for the jewelry sector and to sort of, continue to encourage jewelry exports. These companies would, and normally jewelry processes in India, because they're all handmade, take about 2 weeks. The companies that are implicated in this scheme, in 24 hours, they would just use a machine, make something that looked like a bangle or a chain or a pendant, ship it out to the UAE so that it qualified for the 20% export, which means they could import some more gold. Once it hit the UAE, the gold was melted, turned into bullion gold, and then it went and hit the global supply chain. And this, even though this gold was essentially got from all over Asia, the concentration of the scheme was really split between the UAE and sort of Hong Kong. And it was at this stage that the Indian Bullion Jewelers Association, while the RBI announced the scheme, wrote to the government saying that there is a huge risk here because the banking sector is exposed to over 40.83 billion US dollars to the gold sector. And the CAG report, which subsequently came out, when you looked at all the trades of these companies during that period, found out that, you know, a lot of the times they were just repeated transactions. They would import gold, and then the next day they were able to export it, which showed that they were actually not creating jewelry, creating any value. In a lot of the case, as I mentioned here, a lot of it was companies that were related to each other. So it was essentially, they were just moving profits here and there because it was all associated companies. Now, the one thing that we have not sort of touched on that I want to sort of quickly take a minute to do is commodity market trading, which is essentially the trading of gold on the exchange platform. JP Morgan is now involved in the US in a sort of for market manipulation with over $1 billion fine coming its way for essentially spoofing trades. So what they did was they created fictitious trades in order that others would sort of, you know, make bets on the futures market. Ultimately, it was done in such a way that JP Morgan was able to benefit. Now, the history of commodity trading also has clear on-the-ground impacts, and you've seen that in other sectors. For example, with Chile, which is a big commodity market hub for tin, you essentially saw a cartel, a group of companies manipulate the prices so much that it essentially caused the collapse of the tin market, as well as put the country into a massive economic recession. A lot of Indian traders looked at sort of the way JP Morgan was pegging the rates to decide to sort of has indicators on where to set the Indian gold trade. So there's a relation between sort of the market manipulation occurring sort of at this exchange level to on the ground realities of the Indian gold trade. Now, more recently, there's also sort of been a concern, especially with sort of the height of COVID, which is a lot of sophisticated traders in India are moving towards the commodity markets and are essentially, you know, manipulating futures markets to do money laundering. The simplest scam in this is, you know, if you wanted to sort of turn your black money into white money, creating a profit, is, you know, you place a bet on the Indian exchange, you know, at a really low rate, and then you have someone on the other side, you know, the matching bet on the international commodities market at a higher rate. Now, depending on whether you're wanting to make a profit, to book a profit, or to book a loss, you can essentially, when sort of the contract expires, be able to show, oh, you know, my bet was good. I bought this at a low price in India, and, you know, I've made profits because of it, because I hedged my risks better. Now, what you do is then you settle the difference through a Hawala transaction, which, you know, doesn't really occur. But then, as at least on the commodity market level, because the futures contract shows you made a profit, you are able to now convert black money into white money. And this is an incredibly sophisticated form of money laundering that we are now seeing in the gold sector. It is untapped. So as we talk about risks through the supply chain between the role of banks, bullion gold, trade-based money laundering schemes, the next things to sort of consider and explore is the role of sort of commodity markets, because commodity markets in India are growing, and there's sort of an increasing interest in sort of how they operate and how they operate in conjunction with the rest of the world. Finally, you know, policy interventions. What do we do? There is the need to sort of, you know, better understand how the FEMA Act works, how we should sort of, you know, integrate FEMA into the Prevention of Money Laundering Act, because a lot of the TBML enforcement is done through FEMA. Clearly, in a lot of these scams, we see a distinction between the ability of these companies to operate in special economic zones where there is not enough customs oversight. The Enforcement Directorate has over 8,000 cases, so there's also a question of staffing. India has done, sort of the FIU has done its TBML red alerts, but how much does it involve customs and other excise duty and other departments who do a lot of the on-the-ground work to better understand the risks? Finally, as we've, you know, I've sort of emphasized through this, it is critical to understand the role of trade finance through the domestic supply chain, but also for sort of India to understand the role of trade finance outside India, because it is not the same, as I'm able to show you through my last two presentations and to sort of better understand opportunities for international cooperation. These are some sort of forthcoming reports that we have coming out this year on the gold trade in sort of Colombia, Uganda, as well as commodity trading on the exchange level and the illicit financial flow risks in 2021. And as I mentioned, I am teaching a course on the subject, which is, got a lot of interest from sort of governments all over the world. And if anyone has questions, I'd be sort of happy to talk about the course, but more importantly, on the presentation itself. And, here is my contact information, but I will leave it open for sort of the Q&A at this point.
Thank you, Lakshmi, for that very enlightening talk. And thank you so much to all the participants for your time and for your overwhelming response to this webinar series. Please do feel free to email us at contact@fintelekt.com for any comments or feedback or any further questions that you may have. And with that, it's been a pleasure hosting you all. So have a great day and week ahead. Thank you, Lakshmi.
Thank you. Have a good day, everyone. Bye-bye.
Good day. Bye-bye.